Moving now into Module 9, and this continues on our piece about interview preparation, specifically about using annual reports to help you put together some very intelligent questions and understand the company from a very baseline point of view. We're going to be looking at navigating the annual report, looking at financial ratios, pulling the numbers, running the numbers, and ultimately asking questions based on those numbers. The first thing you'll notice about an annual report is right at the front. This is what's known as the marketing section. It's a message from the CEO and/or CFO talking about the company's last 12 months. It's always positioned as very positive, very glossy. It's designed to keep existing shareholders happy, but also entice new investors in the company. It highlights the previous year and talks about the vision for the coming 12 months, the coming 12 fiscal months, I should say. It talks about the company's community service, employee relations, the economic impact from the company, and perhaps even government relations as well. The one thing about the marketing section is it's a great place to learn. If you know nothing about this company, you can really get a great sense of what this company is all about. Again, what the troubles have been, what the opportunities are, what they're looking forward to, how they've invested their money. It's a great place to get to know a company. You gain great insight into them, and it helps you develop some wonderful questions. The next section in the annual report contains the financial statements. These are made up of three different statements: the balance sheet, the income statement, and the cash flow statement. Now, typically companies will list a 3 to 5 year comparison so that you can see growth or decline year over year. But the numbers don't tell the whole story. We use financial ratios to dig deeper and ultimately to figure out important questions to ask, whether you're asking the actual company in terms of investment advice or in an interview. If you want to dig deeper into financial ratios, there are over 30 different ones you can look at. Try Investopedia.com. It's a great resource. Now, we're not going to look at 35 different ratios. What I put together here is a few that you can look at for just about any company and really sort of glean some key insights and to put together some interesting questions for them. The first is what's known as debt to equity ratio. This is calculated by taking long-term debt and dividing it by shareholders' equity. You'll find these numbers in the balance sheet. Now, this measures the degree and type of financial leverage against the company. Companies are typically financed in two ways. First is debt, which is typically through long and short-term loans, and the second is equity, which is the shareholders' contribution to the company. Now, different industries will have different ratios. Capital-intensive companies like oil and gas and mining and that sort of thing, they'll typically have a pretty debt-to-equity ratio because they need to borrow a lot of money and get very little in the way of short-term payback. If you think about a mining company, they've got to go out and dig gigantic holes in the earth before they actually see any money. And of course, that takes long-term investments. So they'll have a higher ratio. Now, typically what you want to look at is the 3 to 5 year trends that are, again, available in the annual report. Did the debt and equity increase or decrease? And ask yourself, why? Debt can indicate that the company has invested in something to drive revenue. However, short-term, it can reduce profits and even dividends. So what you want to look at is the different types of debt and what have they done with that. They borrowed money. Why did they borrow the money? What have they done with it? And was there any upside based on that borrowing? The next ratio is asset turnover. And this is calculated by taking net sales and dividing it by total assets less depreciation. You'll find these numbers, the net sales in the income statement, total assets in the balance sheet, and depreciation also in the income statement. You use these numbers to determine the amount of revenue created by the investments the company has invested in. How effective has the investments been? That's the question you want to ask. The higher the ratio, the more effective the investment has been. And for a simple example, let's just say that a company has bought a new machine for $100 and sales have increased to $500. So your asset turnover is 5. And again, this will be different for different companies. Back to the mining example, the company may invest millions of dollars in new equipment, but of course won't necessarily see the revenue for several years, and so their asset turnover will be low. But for other companies, retail specifically, you'll want to see a higher asset turnover ratio. The next ratio is the current ratio. This is calculated by taking current assets and dividing it by current liabilities. You'll find both these numbers in the balance sheet. Now, this measures the company's ability to meet its debt obligations in the next 12 months. Put more simply, can the company pay its bills? The norm for this ratio is anywhere between 1 and 2. Below 1, and the company is in danger of defaulting on its debt. Next up, we have net margin. Net margin is calculated by taking net income after tax, divided by net sales, and then multiplied by 100. You find these numbers in the income statement. Now, net margin measures the amount of profit the company earns for each dollar generated by a sale. It's another measure of the company's efficiency and provides some great insight into their operation. Obviously, the higher the ratio, the better. Our last ratio is return on equity. This is calculated by taking net income after tax, divided by shareholders' equity, and multiplied by 100. You'll find these numbers in the income statement and the balance sheet. Now, return on equity measures the ability of the company to provide adequate returns to its shareholders. Different industries, again, will have different ratios, and some companies will return higher results but with greater risk. It's important here to look at the trends, the 3 to 5 year trends that are available in the annual report. Have they been declining or increasing shareholder return over the past few years? Why is that? It could be related to other ratios. It could be related to the fact that they've had major capital investments in certain assets that have yet to create profits and therefore have driven shareholder equity down. So after all that talk of annual reports and financial ratios, I thought I'd do just a couple more slides talking about what's really important as you go into the interview. And there are 3 key documents, 3 references that you should bring with you. The first, of course, is your resume. This is your central reference. This is the document that houses your key message that you want to stay on when you're in that interview. Has all your accomplishments, has all your skills, has your references. It has everything that you really want to talk about in terms of your central message. The next up is your list of behavioral examples. Go and do some research about behavioral style questions. I gave you 3 examples for you to work with, but there are so many more. And make sure you document 2 or 3 examples from your life, from your experience, from your education that you can speak to those in the interview. And the last, of course, is your list of questions. Make sure you bring them along. If you know how much time is allocated to the interview, then you might want to prioritize your questions. What are the 2 or 3 that you absolutely want to get answered before you leave? Those are 3 documents that you should have with you. Don't be embarrassed about having them with you. No one expects you to remember off the top of your head every example and every nuance of your resume. It's okay. In real life, you're never expected to memorize everything, nor should you be in an interview. So have those in front of you, and you'll be good to go. I came across this article not too long ago from Forbes magazine, and it listed the top 5 personality traits that companies look for when they hire. And here they are: professionalism, high energy, confidence, self-monitoring, and intellectual curiosity. Again, I am absolutely certain that you can nail all 5 of these. But it's really interesting, isn't it? Even in the most complex jobs, in a complex society, these are the things that companies look for. It is all about your personality, the ability for you to sell yourself based on, again, your professionalism, energy, confidence, your ability to work independently, and your intellectual curiosity. I know you have those traits. Just make sure they shine through in the interview.